Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. One o'clock on the East Coast. Guy Adami here with the great Danny Moses. It is market call. Demo sitting in, doing yeoman's work. You're a good-looking man. How are you?
Great to be here, Guy. How was your Father's Day?
It was wonderful. I hope yours was as well.
It was great.
It's, I will say this, Father's Day, and rightfully so, should take a back seat to Mother's Day. Mother's Day is the important one. Father's Day, bit of an afterthought, and for good reason. With that said, you heard the tease at the beginning of this, sort of the market brought to you by CME Group, where risk meets opportunity. Well, Danny, there is no opportunity if you're bearish. I mean, there is no risk clearly in the market. It is all opportunity because, we are off to the races here. And before we get to the rundown, just as you see a day like today, benign day where you just have this levitation, what's the thing that comes in your mind? I know a few things come to mind.
No catalyst to really sell anything. The market doesn't believe the Fed, which we're going to get into. The market's pricing in north of 2 cuts this year, beginning in September, and the Fed's basically saying 0. So you have this so at some point the Fed is probably going to come towards the market, and that's reason enough to either not be bearish or stay bullish, feeling like you have the Fed, basically at your back. So I think that's the overriding. And then it's kind of a quiet week, not a ton of earnings. You got a holiday in the middle of the week, so I think the trading will be low. And again, it's not going to pay right now to take risk and go short this market. And you just talked about strategists, which we'll get into here, but listen, it pays to just stay long the market here, I guess, at this point.
The Steve, I'm haunted by Steve Eisman from a few weeks ago on the On the Tape podcast. And, the new and improved, if some might say, Steve Eisman. I mean, he is not bothered seemingly by anything. And that's the right, listen, God bless him. I mean, that's the right posture to have. And, all the times that I've tried to find things to be concerned about, I mean, they haven't gone away, but clearly haven't impacted the market. So we'll see. Anyway, let's throw the rundown up because you mentioned some strategists shifting gears here. That's where we'll start. Strategists up in their S&P price targets. Market breadth, which has not been great, but again, doesn't seem to be a concern yet. Bond volatility, it's still here. It really hasn't gone away. And bet on some gaming stocks. This is one you've talked about a number of times. So let's get right into it. Let's look at that first slide because it speaks to, what's going on here. This is Evercore ISI. This is Julian Emanuel, Danny. And we know Julian, I think he does extraordinary work. He was, I think, I shouldn't say low on the street. I think he had a 4750 price target for the S&P 500. I still think Marko Kolanovic is still low at 4200 or so, but he just raised his forecast to 6,000. We'll talk about that. By the way, Goldman as well, I think they put a potential for 6,300. So let's talk about Julian's piece because you read the note, and really what it comes down to is you really can't quantify why things are going up, but there's obviously exuberance in the market.
Yeah, 4,750 to 6,000. Again, it's just a number, but valuations be damned. 25 times his this year's 2024 estimates of $238. Basically saying you have earnings growth that's better than expected. That's fair. Looking, I think, at 8% earnings growth here. And the AI phenomenon, you really can't put a price on. So he called that exuberance. So give him that there. But there's no talk about historic comparisons at all on this, and we all know how expensive that is. It admitted it's top heavy, and basically said what I just said at the opening here is that the Fed's going to have your back at some point. So why fight it? That's another tailwind, and he just caved and gave in. And that was basically the gist of the note. And again, fundamentals are decent, earnings are better, but are you willing to pay this 25 times? To me, and then looking, I think his number for 2025 is something in $251 level or so. So to me, that's a little bit steep to pay, especially, and we're going to talk about kind of the breadth of the market, why it is looks so dangerous, I think in our opinion. So
yeah, and it's been that way for a while. And I think, listen, again, I'll say this, Julian does great work. Mike Wilson does great work, but at a certain point, in those seats, the markets almost forces your hand. And I think to a certain extent, that's what we're seeing. And people ask me all the time, what will force your hand? And, I'll be the first to tell you, in terms of the S&P, I've been dead wrong. The broader market, without question, has confounded me for quite some time. I mean, I think we've done a decent job with some things. I think I've done a terrible job with others. But the market in the form of the S&P 500, just this sort of levitation that continues, I'll use the word, is somewhat dumbfounding. And I think all these analysts one by one, or strategists, or whatever you deem them to be, they just get browbeat by the market. And as here we're in the middle of June, at a certain point, that counter effect kicks in where if you've been behind the curve, you're going to start to chase, Demo.
Yeah, because you're going to, like I mentioned before, lower amounts of liquidity in the market. Give me a reason to sell versus a reason to buy, or just stay long. It's easier, obviously, on the latter. At this point. And again, we've been saying this for weeks. I think the proof is really the bears need to prove that it's a reason to sell this market. And the U.S. market in general is still the sexiest game in town if you think about it globally. And so I can see the whole bullish narrative, obviously. And again, I try to ignore the S&P a little bit and focus on single names, which I know we're going to get into here, and just do it that way. But this is not, becomes self-fulfilling, to your point. And Julian, probably his phone wasn't ringing for weeks. He couldn't get meetings, I'm sure, and he had it. But again, I say to the people out there, when you see the bears, if you want to call them that, capitulate, it should make you a little bit nervous, because who's making the points on the other side? And I think we're on one side of the boat here, but it can stay that way.
No, it's fair. And, again, I think it's interesting you say that when everybody starts to your word, capitulate, and there's nobody left to sort of show you what the bear thesis can be, by definition, it hasn't gone away. It's still there. It's just that nobody's willing, or quite frankly, able to voice it, or I don't know, sort of explain it in a way that makes sense, because the market is a judge and jury. And if the market goes up every day, nobody really wants to hear the things that can go wrong. But with that said, market breadth is something. And Morgan Stanley had an interesting chart out. So let's take a look at this. This, in some ways, tells a completely different story. This is, you look at, equal weight S&P. You look at basically the underperformance of the Russell. We throw the transports in there as well. But, what you're seeing is, if you think about it, this tells you that the market is being dominated by, again, a handful to 10 different stocks. And that's manifesting itself without question in charts like this, Danny.
Yes. And then the podcast we had on the tape that was released Friday, we had Vincent, Daniel, and Porter Collins on. And Vincent spent a ton of time talking about market structure in general and passive versus active. And this is really culmination of all of that. When you look at it, it becomes self-fulfilling. So these bigger names become bigger over time. And until there's some type of bump in them or a problem, Guy, this is going to stay in force. But people out there, this is not healthy. Does the overall S&P look good? Sure. But peel it back away. You have 2 or 3 names that are really supporting it. This last big run, kind of the last catch up, was Apple, to kind of do this. And now you're seeing this from a breadth perspective. Again, I would argue that there's lots of names that have been left for dead on the long side, not the short side, that people are so focused and own these bigger names. Guy, why? Because they have to.
Yeah.
Because if there are passive funds that they're being targeted against, they have to own them. And so higher prices beget higher prices for now. Will that turn at some point? I don't know. You just brought up the seasonal aspect of the summer in July, which Goldman wrote on a few weeks ago, when retail flows start to accelerate. I don't know. I'm not going to try to time that perfectly, but I am going to buy value over really what I think is maybe extended growth at this point, guys.
No, and I think, the bulls will push back and say, look, at a certain point, those underperformers are just going to start to catch up. I think to a certain extent, that's part of the bull thesis as well. And listen, maybe that's the case. Maybe in fact, that's what will happen. You'll get a breakout in the Russell for the first time in a year and a half. And the transports, which obviously have not been participating, will start to play catch up. And maybe even you'll see something in the regional banks. However, I'm not one of those people. I think laggards are laggards for a reason. And if the broader market were ever to turn, I think that's when you're going to start to see at least some of the exposure out there that I don't think people are fully aware of. With that said, you mentioned ETFs and passive flows. I read last week, and I don't know if this is accurate. I'm trying to find out exactly, but I bet you it's close, that NVIDIA is now over 400 ETFs have NVIDIA as a top 15 holding. And let's look at that NVIDIA slide, because Barron's obviously put a note out talking about this time Chris Rowland raising his price target to 160. And that's, 51.5 times of his 2025 earnings. And maybe that is reasonable given their growth rate. It seems a little excessive to me, but people are clearly now tripping, not only in the broader market, they're tripping them over themselves in this name as well.
Let me explain again for people out there who haven't dealt in the professional investor community, and having sat on a trading desk, on the research desk, on the sales desk. If you're an analyst and you want to come out and speak on a name, and Guy knows this and people know this, you go to your research director and say, I'd like to go to the podium this morning. Okay, what do you want to talk about? I'm going to talk about NVIDIA. What are you doing on it? Well, I'm going to raise my price target, because if I come out right now, my price target is still 100 or 110, post split, you can't really come out with a logical call. So I'm going to raise my target so that I can talk about it. And they backdoor their way into this 51.5 times adjusted earnings for next year. Again, this is hardware. Can it stay up here in the mid 70 gross margin for a period of time? Maybe. But you got AMD on your heels. You have Intel on your heels. At some point, the secular trade reverts a little bit, even a little bit, to cyclical. But again, that's how this works. And so people raise their price targets or downgrade the stock. You think anyone wants to go out and downgrade NVIDIA right now? You think they want to deal with that right now? Absolutely not. So you see price targets being raised. You see strategists on the S&P raising their targets just so they can get out there and talk and be relevant right now. But again, Guy, one side of the boat should scare everybody a little bit. So
no, it scares me. And let's hope if we can.
What? Now you got me rolling. What's the difference in 40, 45, 50, 55, or 60 times, adjusted earnings? There is no difference when you see this unrelenting growth. But anyway, please go ahead, Guy.
No, I mean, look, and let's put up so that's a static NVIDIA chart. If Amanda or Jacob can put up a, real-time, longer-term NVIDIA chart, this is now post-split. So it takes into consideration a lot that's going on. I mean, you can't even see some of the gaps that are still in this chart. And that goes back to, I think, May of last year when you had that huge breakout. But, this in a word that you can see it now. Now, if you put your cursor to that April to May 2023 move right there and right there. So you see that gap still exists. And again, I'm not suggesting we're closing that anytime soon, but that gap has never been filled. And then you have this other gap. If you go later in the chart, you'll see it's clear as day. That gap right there. So you have two major gaps in this chart. Obviously, you have a moving average that's been sloping higher for a while. And that 200-day moving average is probably going to approach $70 or so. But you can see where we're trading right now in terms of NVIDIA. And again, at a certain point, everything becomes mean reverting. But when you see a parabolic move and now a stock that's north of $3 trillion, I mean, by the way, that's sitting on expected revenue next year of, I think, 150, let's round it up to $160 billion. So you're talking about a company, Danny, that's trading close to, well, I won't say 19 times or so revenue. And I mean, that is historically probably double what a lot of these, at least historically, a lot of these semi-stocks trade at. Now, people will say it's different this time. Maybe, or maybe it's not different this time. And maybe, it's just this euphoria is taking over. What are your thoughts on that?
Yeah, I mean, that's looks like it should pull back at some point. Have three stocks, I believe, with Microsoft, Apple, NVIDIA, 10 trillion in market cap, roughly, or approaching somewhere in that level. That's astounding. And at some point, the math just stops working as far as AI specific for NVIDIA and all the, companies associated with AI. Again, add up those market caps. The math doesn't really work. There's going to be winners. There's going to be people that are going to catch up over time. But again, Guy, it goes back to passive and chasing.
Yep.
Again, you can't afford not to own this. And so it will have a correction, hopefully a healthy correction, gives people an opportunity to buy it, but it will feel bad when it does correct even 5, 10, 15%, because then you'll have all the people, and I'm not going to be one of those told you so, it was going to come in and all that. But you know what? At this point, every dip in many of these names has been bought, both in the market and individual names. And again, the proof is on the bears to tell people that they're going to be wrong. In this story, give them credit. They have caught up. They can justify the multiples right now based upon the growth rates that we've seen since you pointed to in that April or May of last year. Mm-hmm. It's there, but it can't continue. The math just won't work. So at some point, the math doesn't work, Guy. And until then, good luck to everybody.
Yeah, well, I don't want to get bogged down in NVIDIA, but if we could do shorter term, you'll see we actually did see a pretty significant pullback. On March 8th, it was a Friday. That stock made a then all-time high. You had this engulfing pattern. Stock traded sideways for a couple weeks. And then he had a pretty significant drop-off into basically middle of April with the broader market, but then it caught a bit again. So it's not like it doesn't sell off. And it's interesting you said, I think a sell-off will be, for a lot of people, welcome. The problem is, for a lot of people who've been piling in late to this thing, I don't know, because as market takes the stairs up and the elevator down, and I don't think this is going to be impervious. So I'm curious as to the first analyst that actually comes out and says, we've seen peak margins. This multiple in terms of price to earnings doesn't make sense. And we're putting a, $95 price target on NVIDIA. It's going to be fascinating to see if and when it happens, but that's for another show. You're good at this stuff. I'm not. Fed dot plots and where we are. And you sort of teased it earlier in terms of, some of the thinking behind some of these Fed officials. So let's talk about this.
Yeah, so they come out every quarter. So basically every other meeting, the Fed comes out with their projections for economic growth, for where they think rates are going to be and so forth. And like I said before, the market saw right through this, even during the press conference. And the word Goldilocks is now being thrown around more than I've heard it in quite some time. And again, they can say all they want. I think they took the opportunity. As a matter of fact, someone asked Jerome Powell during that press conference, you had access to that CPI number, right? And he said, yes. Did you incorporate that? Well, kind of, sort of. Some you could if you wanted to and so forth. So they have the ability to talk a hawkish game, knowing what the real numbers are. And I think that's what the market is basically seeing through. And again, the bulls will point that this is a tailwind, and it's probably true. Conjoin that with quantitative tightening, tapering, right, from 60 billion, a month runoff to 25 billion treasuries only in that regard. And so you do have this. So I think they're trying to talk a hawkish game to talk the market down a little bit. So give them credit. They saw an opportunity to do that and did that, but no one believes it. And again, I'll go with what the market's saying versus what the Fed is saying.
I give them a lot of credit. I mean, in terms of what the market's done, I think they've done a masterful job just through the lens of the stock market, because as we're sitting here, the stock market's at an all-time high. So they're able to raise rates the way they were able to raise them outside of a little hiccup here and there. I mean, it's been pretty smooth sailing. So good for them. I read an article, I think it was in New York Times, and somebody can at me if I'm wrong, but again, a lot of the inflation story, and again, the Biden administration taking victory laps in terms of the slowing of the rate of inflation. It's disingenuous, but whatever. But if they measured inflation the same way they measured it in the early 1980s, inflation would have peaked at 19.5% when we saw that basically high print. And right now, currently, we'd be probably either side of 9% inflation. Again, I don't think anybody really cares necessarily, but I do think that explains why people feel so shitty about the economy and why the president's approval rating in terms of the economy is as poor as it is. Because as much as they want to say inflation is under control, if you actually were to measure it the right way, it's anything but, Danny.
Well, the Fed also knows that the comps are going to get harder here on the inflation because it came down so hard last year this time over the next 6 months. So they're also concerned that it's going to look higher on a relative basis versus an absolute basis. So the optics, are certainly really important for them. And so I think that was partly factored into kind of their thought process during the presser. And also to your point, I think the article was more than 50% of people think we're in a recession.
Right.
And let's be clear, people watching this, most people watching this are in the markets, but 99% of people don't, not 99, but you know what I mean? A large percent of people don't care about this. So there has been this wealth effect, and the haves and the have-nots continue to bifurcate even more. And I think that's really what you're saying. And the market wealth effect is real. And I think he's a little bit concerned, Powell, that that's going to ease credit conditions too much and kind of tie his hands a bit. But I think the one thing, Guy, that I'll take away from this is when the Fed does start cutting, whether it's September or not, and you have the election, so it may muddy the water a little bit, but I believe that's going to be the first of many in a row, because for them to start, unemployment is north of 4%, probably approaching 4.3, 4.4%, and inflation is really slowing. The problem with that is the economy might be slowing. And if the higher end consumer catches up even a little bit with the lower end consumer, then you could see a series of rate cuts. And I'm not going to try to predict what the S&P is going to do at that.
No, and I don't know if that's bullish or bearish, quite frankly. So we'll see. But that leads us to this Fed Watch tool. I mean, this is for December, I believe, if I'm not mistaken. And this, you can read this, but please walk me through this, because obviously it gets you through the election. So whatever happens here, although, they're going to be people that's, regardless of when they do it, to say it's political, because if they wait, they'll say they waited to hurt Biden. If they do it before, they'll say they did it to help, whatever. But here we are. And so this is what the market is looking at.
Yeah, so that's end of the year, so it doesn't show meeting by meeting, but the end of the year is basically saying, I think, north of a 62 or 63% chance of 2 rate cuts and maybe even 3. So you can see that currently the way to read that is we're at 525 to 550. I can't see all this print, but we're in the mid 40s percent. I think we're 475 to 500. So that tells you that's 50-50 on 2 rate cuts. And then a little bit more beyond that, the next level up or down, who we're going to look at it, there's mid-teens percentage chance. So you put those together, you're in the mid 60s of 2 to 3 cuts. And again, Fed saying basically 0 to 1, and the market saying 2 to 3. So we'll see.
Yeah, and that's your point. I mean, exactly. And you said this earlier in terms of, the market not believing in the Fed. And I think Jerome Powell, I think he's trying to, I don't say warn people. I think he's trying to be earnest in his views and his assessments. But the market's looking at something entirely different. And again, what we don't talk about nearly enough, I don't think, but once we got into March, the inversion on the yield curve set a record for terms of duration of being inverted. I think the prior long was somewhere between 1970 and 1980. Now here we are. And that whole inverted yield curve story, which was a story for a period of time, nobody seems to talk about it anymore, Danny. Nobody clearly seems to care about it. It's still out there, though. And depending on what day we're looking at, I mean, it goes anywhere from sort of 35 to 45 basis points inverted. And again, market seems to be sort of ignoring it completely. Are they right to ignore it, or is this something that's just sort of hiding out there in plain sight?
Well, again, it'll fit into the narrative if the market sells off. It'll be, well, obviously, we had an inverted yield curve, but we are north of 2 years into this aggressive rate hike campaign that's been going on. And quote, what blew up? A few regional banks blew up. Could it have been major? Yes. But what happened? The government stepped in again with massive programs and liquidity, right? They came up with a new acronym, BTFP, whatever it's going to be. Mm-hmm. So again, I think that the moral hazard thing that you're really referring to and talking about, when will any of this stuff matter? And to be fair, we've had earnings growth, even in an inverted yield environment, and people have been able to get around. But let's not kid ourselves. There's still massive monetary stimulus, fiscal stimulus that had been into the system. And so this traditionally, you get an inverted yield curve, that's really 2-year yields higher than the 10 that we've talked about. There's a reason that happens. It normally happens in a rate hiking cycle, which we got part of. But normally the economy slows down because it's indicative that the 10-year yields obviously are coming in for a reason. So we haven't had the confirmation, right, of the negative things that have occurred yet, except for, technically speaking, these regional banks that basically went out of business. And so that was one casualty that we kind of threw under the rug, Guy. But again, that narrative was not going to matter. Like the whole inverted yield curve matters. Why? It doesn't matter. It means nothing. Mm-hmm. It means something to banks that, borrow and lend. It means something to fixed income traders. It means something. But as far as the S&P and earnings, it doesn't really mean anything. Right now.
I guess not. But it also, if the economy is ever, if the economy and the stock market ever realigned, I think it means something in terms Correct. Of the economy. But, again, that's another story for another day. Why should I care about France? So let's take a look at some of the charts that you wanted to bring, because I agree with you. Again, the market's not paying any attention to France. And quite frankly, if you want to expand it out, what's going on in Europe. And, here we are, Danny. So walk me through this.
Yeah, so I go back to Bank of England and Liz Truss, whose 6-week term as prime minister over in the UK in October of 2022. What did she want to do? She wanted to cut taxes. Well, what happened? Obviously, yields went skyrocketing. The gilt went skyrocketing over there. The currency got hit. She gets ousted. BOE comes in and buys bonds and saves the day there. Now, let's separate that for a second. So Brexit has occurred already. So the UK is on its own footing, and the euro or the ECB or however you want to look at it is obviously one thing. So France is part of a bigger thing. But France debt to GDP is about, I think, 110, and we'll get to that in a minute.
Let's look at that slide because,
it's important here because an election, and now they've called basically lower parliament elections in France, so not the official President Macron going out, right? What does that mean? If the far right comes into power, they want to cut taxes and be more nationalistic and lower the retirement age and all that stuff, obviously that would have an impact on their fiscal situation. And so that's what we've seen. We've seen the stock market sell off in France, right? And we've seen the bond yields move higher. They've come in a little bit, but now we have snap elections, June 30th, July 7th. And here we go again. Again, it's for lower parliament, but it will send a signal. And so the concern would be that how you basically elect people in parliament and to run your country can have an impact on your sovereign stability, so to speak. We saw, again, we've seen in Japan, we've seen in England, we're seeing it in France, and God forbid we see it here in some form or fashion. So I guess my point is that you need to pay attention to these things and policies, because when you're dealing with debt to GDP like we have approaching 130 here in the U.S. and certain policies, this is my point. There's no tax cuts coming here in the U.S. And so if you're catalyst driven that whoever wins our presidential election and the houses of Congress is your theme, don't count on tax cuts, in my opinion, because you could have a situation like we saw in Bank of England and like we've seen a microcosm of that in France. So
elections have consequences. You mentioned that again. I mean, you saw that now the sell-offs in these two didn't last all that long, but you saw what happened with Mexico in that election. Then you subsequently saw the India election. It had basically a 1.5-2 day sell-off, and that got right back on its horse. But to your point, these things do matter. And I don't know if we can pull up and watch what I do here, a Cacaron chart in terms of that bourse.
Yeah.
But to your point, it hasn't been trading particularly on. If we can't, Amanda, there you go. So look at that. And again, that's a pretty significant move. If you go longer term, you'll see exactly what I'm talking about. You don't see moves of this magnitude every day to the downside. Now, maybe you can say that uptrend from April 2020, if you want to draw that trend line, that uptrend line is in place. And maybe that's effectively what we just traded down to and are holding-ish. But man, oh man, when you see a move like that, Danny, you have to take notice.
Yeah, for sure. And it was a 3 to 4% sell-off rather quickly, to your point, and then things have somewhat stabilized. But again, where does the money go? I guess it came to the U.S., guy. I guess it's coming into the U.S. market, seriously, because why do I need to deal in France? I'm not going to deal with that noise. I'm gonna put my money somewhere else. So I think that's what you're seeing is just a reallocation, so to speak.
I want to talk about gold real quick because I know you share the same view I have. I mean, obviously, it's not performed all that well recently. It's been sort of treading water. It's not going up, but it seemingly stopped going down. I think everything we just talked about lends itself to gold. I think that leg lower in gold was on the back of the announcement that Chinese didn't buy gold in the month of May. First time they hadn't bought gold in quite some time. So I think that took the market a little off guard. I don't know what it means necessarily. I don't think they're done. That's just me. Quick thoughts on gold.
It's actually held up relatively well. You say all those things that have occurred and it's still here. And so, again, I think kind of like Bitcoin and the rest of crypto, it's a hedge against the incompetency of the central banks. We'll see what happens here, but I think we're going to, consolidate here and continue to move higher. I'm still long it. I know you're still long it. I would buy it on any weakness, barring a true hawkish tone that's met with reasons to be hawkish. So if you start to see Fed fund futures come back in with 0 rate cuts that match what the Fed's saying, gold will probably get hit at that point, in my opinion. So we'll see what happens. But with all the geopolitical risks that are out there, Guy, it's a hedge on incompetence globally, and I'm still long gold here.
It's something I've said for a while as well. And the two names that you've talked about, and let's look at DraftKings, as Morgan Stanley had a note. They are suggesting that they could see DraftKings announcing $1 billion stock buyback, and that got that stock on its horse today. But Flutter and DraftKings are two names that you wanted to discuss here.
Yeah, they pulled back sharply. What happened several weeks ago in Illinois?
Illinois.
Moving higher from 15 to 40%, but you cannot deny the amount of tax revenue that is supplying across the United States to the states which actually have enacted online gambling has come in. And so it's too big to ignore. It's one state. People are concerned that New Jersey and Massachusetts are going to follow suit. I don't see that happening. Even if it does, I still think these stocks are a buy. They got oversold on that news. Morgan Stanley had a note out on DraftKings from a free cash flow perspective, saying in the back half of this year, they see them basically announcing a potential $1 billion stock buyback. That's off of generating something in the 400 to 450 free cash flow level. And then on Flutter, which is still covered at Morgan Stanley by their UK analysts, even though they're now listed in the US, stock got hit as well. It kind of got caught in this leaving the UK and being in the FTSE and all the indices there and coming here and not being yet instilled in all the passive funds here. To me, this is much cheaper than DraftKings. It's much more diversified. If people want that or not, I don't know. But Flutter is kind of the king, and it trades at a much sharper discount than DraftKings. And what they're saying, Morgan Stanley, is there's an analyst day, I guess their annual meeting in September, that Flutter's going to announce a bunch of things that'll be a positive from a reorg perspective on their poker business, et cetera. So I'm a big buyer here of Flutter. And it certainly was a great buy the dip on DraftKings. I think it probably has another 10% left in that thing before you can ask any questions.
Couple questions. This is from Situation Room. I think that was somebody from the Jersey Shore. Basically, it's a statement. Microsoft blow off top. And man, oh man, first of all, I like your icon or whatever that thing is called. Let's throw up a Microsoft chart. It's up 1% today. It's amazing. Again, this is north of a $3 trillion company. It basically vies with Apple and NVIDIA on a daily basis to become the biggest company in the world. I understand the importance of Microsoft without question. But if you look at this, there has been no stopping this thing. And I'll tell you, at current levels, because to me, all this is multiple expansion. You're talking about a stock that's now probably trading close to 32 times next year's numbers. I know you don't trade things on valuation, nor should you, but man, oh man, things are getting a little dicey out there, Danny.
Well, Mike Wilson in his note talked about what you want to own in this type of environment, and it's large cap growth. And these names are viewed now to be defensive in nature. So people are willing to pay a higher premium knowing they have stability in earnings. And so I can see why. But again, a 32 down to a 25 down to a 22, to me, there's not a ton of difference. At some point, obviously, when you do start to correct, my concern, Guy, in many of these names is what is the buy point? Because it's not 30, 28, or 26. So at some point, but again, proof is on the bears to base out. And so this is a safe name. You can own it. You know you're going to be okay. Even on a pullback on a mark-to-market basis, you'll get hit, but you can still feel good about owning it. I think the market is paying a premium for those type names.
This is an interesting question from Chris Munzo. Question for Danny and Guy. Why are stock buybacks considered returning capital to shareholders? Jamie Dimon said it's returning capital to exiting shareholders. I didn't catch that Jamie Dimon thing, but just let's focus on the first thing. I mean, my short answer would be, and Danny, you probably have a much better answer than I do. I mean, I would imagine by basically retiring shares, buying back stock, you're effectively returning capital to shareholders vis-a-vis that and the stock appreciation. What are your thoughts on that?
Yeah, you have a choice as a management team. Do you issue a dividend or you buy back stock? You buy back stock if you think your stock is cheap relative to its long-term forecast. Jamie Dimon basically decided that wasn't the case, right? So people are like, why aren't you buying your stock back? He goes, at these levels, that's not what I would do. And as far as paying a dividend, so it's returning because you were lowering the share count. So you're basically improving all the ratios that are out there.
Exactly right.
Shares outstanding. That's really all it is. So you're retiring shares into the treasury, so to speak. So that is
and that's why that's exactly, you said it better than I, but that's exactly right. And before we get out of here, Danny, and thank you for your time. So we created this AI, not generated. I mean, I guess it's generated, AI generated, not generative AI.
Look, you're adding to the AI craze. You see that?
We are. I mean, we're jumping right in. And I think this is week 4 now. It's amazing how quickly that goes by. But we call it Brunson. We all, you, me, Dan, Amanda, Jacob, Timmy, even Bill Hockman throw some ideas out there. And whatever we think is the most interesting idea, we throw it in here. And at the end of the day, right after the market closes, you'll get anywhere from a 5 to 10 minute AI generated podcast talking what we think are the big stories of the day. It's pretty cool. Dan would call it a vibe. That's not something that I ever used before. We do call it Brunson, and people seem to be enjoying it. I know you seemingly enjoy it, Danny.
Yeah, it's great. It's a great summary of everything that's gone on. And I think it'll continue to improve because, AI learns from itself, Guy. It continues to improve upon itself. So by definition, this is only going to get better, the market matrix. So have a listen.
It's absolutely terrifying. I will be doing Market Call from Indianapolis tomorrow, special time. So please indulge me. Noon Eastern time tomorrow, not 1 p.m. Amanda, I don't know if we have a slide for that or not, but I have something tomorrow in the great state of Indiana. So noon Eastern time tomorrow, Market Call. Wednesday, a bank and market holiday, Juneteenth, and then we're back on Thursday. So thank you, Danny Moses, for joining us. That was a lot of fun.
Great to be here.
You're the man. Thanks, folks. Talk to you soon.